Welcome to Global Experts Network Learning Platform. I'm Samson Nsengiyumva, and I'm delighted to have you here for Module 2 of our Investment Analysis and Decision-Making course. Today, we dive into the heart of corporate evaluation, financial statement analysis. We'll explore how to read and interpret company financials to assess their health. Our overview covers understanding financial statements, ratios, cash flow, and practical analysis. By the end, you'll be able to interpret income statements, balance sheets, and more. There are three core statements: the income statement, the balance sheet, and the cash flow statement. Each tells a different part of the company's story. It's important to remember that these statements are interconnected. As we go through each, think about how a change in one affects the others. Let's look at the P&L. The income statement, or P&L, shows performance over a period. It starts with revenue, subtracts costs like COGS and operating expenses to reach net income. Looking at this example for ABC Company, we see a clear flow from $10 million in revenue down to a net income of $1.35 million. Next is the balance sheet. This is a snapshot in time. It follows the fundamental accounting equation: assets equal liabilities plus shareholders' equity. The balance sheet tells us what a company owns and what it owes. It's about stability and resources. Let's break down the structure of these assets and liabilities. Assets are divided into current and non-current. Similarly, liabilities include current and long-term obligations, followed by the shareholders' equity section. The cash flow statement tracks actual cash. It's divided into three sections: operating activities, investing activities, and financing activities. Cash is king. Remember, net income and cash flow are different. A profitable company can still run out of cash if its operating cash flow is poorly managed. Quality matters. Understanding the relationship between these three statements is the foundation of analysis. Now, we'll move into the tools we use to compare companies. Financial ratios. Ratios help us compare performance across dimensions. We'll look at 5 major categories: liquidity, profitability, leverage, efficiency, and market ratios. Liquidity ratios measure a company's ability to pay short-term debts. Key metrics include the current ratio, quick ratio, and the most conservative, the cash ratio. Profitability ratios like gross margin and net margin show how efficiently a company generates profit relative to sales, assets, or equity. ROA and ROE are critical. While profitability is vital, we must also consider how much debt a company is carrying. This brings us to leverage and efficiency ratios. Let's take a look. Leverage ratios, like debt to equity, measure the extent of debt financing. We also look at interest coverage to see if a company can comfortably pay its interest. Efficiency ratios, like asset turnover and days sales outstanding, measure how effectively a company uses its assets and manages its daily operations. Market ratios relate stock price to earnings and book value. The P/E ratio and dividend yield are primary tools for investors to assess market perception and value. To get a holistic view of ROE, we use the DuPont analysis. It breaks down return on equity into 3 distinct components. This is where analysis gets deeper. DuPont breaks ROE into net margin, asset turnover, and equity multiplier. This shows whether profitability is driven by efficiency, margins, or leverage. Free cash flow is the cash available for shareholders after capital expenditures. It's often a better indicator of financial health than net income alone. Working capital is current assets minus current liabilities. It shows the capital available for day-to-day operations. Too much or too little can both be risks. Now, we need to talk about the quality of those earnings. Not all numbers are what they seem. Let's look at some red and green flags in financial reporting. High-quality earnings are sustainable and backed by cash. Be wary of net income that significantly exceeds operating cash flow or aggressive accounting policies. Common size analysis expresses items as percentages to compare companies of different sizes. It's particularly useful for seeing trends in the income statement. Trend analysis identifies patterns over multiple periods. For example, stable and improving profit margins are a strong indicator of a healthy, growing company. Comparing a company against its peers is just as important as looking at its own history. Comparative analysis lets us see relative performance in an industry. By comparing metrics like ROE and debt to equity across companies, we can identify which players are financially stronger and have lower leverage in the same sector. Always read the notes. Footnotes provide critical context on accounting policies, lawsuits, and debt details that aren't visible in the main statements. Watch out for red flags like frequent restatements, auditor changes, or deteriorating cash flow while earnings grow. These are warning signs of trouble. Now, let's put theory into practice. We have a company analysis exercise. I want you to assess TechCo's liquidity and earnings quality based on these numbers. Calculate the profit margin for TechCo. Compare its net income to its operating cash flow and evaluate its liquidity position using the provided ratios. You have many resources at your disposal, from SEC Edgar to financial databases like Bloomberg. Software like Excel and Python are also powerful tools for analysis. To summarize, financial statements tell a story, ratios provide insights, and cash flow is vital. Take a moment to review these questions before we move on. Module 2 is complete. Thank you for following. Please subscribe to our SNB Experts YouTube channel for more. Goodbye and see you next time for Module 3. Module 2 is complete. Thank you for following. Please subscribe to our SNB Experts YouTube channel for more. Goodbye and see you next time for Module 3.